Hello and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. in the summer-like Pacific Northwest. We are live on Facebook. I hope everyone's doing great. Hope you're staying healthy. Hope you're staying safe. Hope you're staying sane. Always an important thing to stay sane. And I hope you guys are enjoying and getting ready for a beautiful summer. It's finally here. And that's a big deal in the Pacific Northwest. Now, I know my friends in Texas and people in Florida and probably in Southern California, Arizona for sure, all these wonderful hot states, y'all have had summer since about February. I get it. But the rest of us up here in the Pacific Northwest, on Monday, it was like 50 degrees and rainy. So it's really nice that we finally have summer here, and it's a wonderful opportunity for us to have barbecues, which you know I'm a huge fan of. Cooking meat on fire, always a delight for me. And it's time, and boy, it's past time in the Pacific Northwest. And the cool thing is that when we do get summer, when it finally does come here in the Seattle area, it is absolutely glorious. So I'm excited. I've got some weird sun things happening behind me with regard to the windows and the shades. I will apologize to you guys in advance. I'm a little off guard today. I've been working on mortgage lending and other things, and the 2 o'clock hour just came up on me by surprise. I am, in fact, working from home. As you can see, my COVID balls from the ceiling, and I've got the dishwasher going as well. So a real interesting time to be talking with you guys. So I apologize. It's like a throwback to 3 years ago when we were in the midst of all the COVID craziness and the lockdowns, and people were just doing whatever they could as best they could. Of course, my hair looks better than it did at that time. I am getting regular haircuts. So we got that going for us. Anyway, what else do we have going for us right now? Well, we have the Federal Reserve Board, the FOMC, that's the Federal Open Market Committee. That's the component of the Fed that actually meets and votes and has conversations about what to do with this crazy inflation that we have been inflicted with. And they vote on that, and they make announcements on interest rate changes and things of that nature. And they did, in fact, meet earlier this week. I think it was earlier this week, yes. And they meet for 2 days every 6 weeks. And the result of that meeting was that they decided to skip raising interest rates right now, which is, I think, a probably a good thing. When they say skip, this is very government agency sort of thing. Like, what does that exactly mean? They are very cautious in the words that they choose to use. So they could have said, we're going to pause, for example, on raising interest rates, but that would have sent messages to the investment world, to the markets, to everyone who's paying attention, that they may be done raising interest rates. And heaven forbid, they don't want to share that kind of posture or suggest that kind of situation to the rest of the world, because they're not done. When the meeting was over, so they meet for 2 days, and the first day they do all the nitty-gritty stuff. It's all behind closed doors, and they just keep it to themselves. And then on day 2, they announce their policy decision, and they make some kind of statements to the media and things of that nature. And then after that meeting or that announcement, then various members of the Federal Reserve Open Markets Committee are also going to address the media. It's not just Jerome Powell, the chief of the Federal Reserve. I apologize, it was last week that they met, not this week. This week, he's testifying, Jerome Powell's testifying in front of Congress and the Senate and whatnot. And so they want to be really, really guarded and cautious with the language they use and the words they choose. So they didn't say we're going to pause, because that suggests more than one time when they're not raising interest rates. So instead, they said, we're going to skip raising interest rates this time around. And so where we are right now is the Federal Reserve's short-term interest rate is somewhere around 5% to 5.25%. I know it's weird that we don't have an absolute like 5.240%. It's a range within a quarter of 1%. That to me is really odd in and of itself, but no one really asks me any questions about these things. So my opinions I keep to myself and I share with you guys. But what did happen after the meetings, in addition to everything else, is that 9 voting members of the Federal Reserve Open Market Committee said that they want to raise interest rates at least 2 more times this year. So that would take rates to somewhere between 5.5% to 5.75% on the Fed's rate. Now, you got to understand that the Fed's rate, this is the short-term rate. This is kind of like the lender of last resort to all of these banking institutions that may need to get liquidity for a short period of time. So when they raise those rates, the banks, of course, pass that on to you and to me in the form of higher rates on credit card balances, higher rates on home equity lines of credit, higher rates on personal lines of credit, business lines of credit, everything rolls downhill, as they say. And so when the Fed is saying, hey, we're going to raise rates probably another 2 times this year, they're telegraphing. I mean, they're not holding back. They want the economy and the markets to know that they are really, really, really serious about handling inflation. And frankly, I am quite tired of listening to the Fed. This is my job. It's also my passion, so I'm going to continue doing it, of course, and I'm going to continue sharing with you guys what they're doing and how they're doing it. But between you, me, and whoever else is listening, I find the Fed to be absolutely a failed experiment, especially in this go around, as I am so attuned to what they have done and what they have said over the last 15, 16 months, and even before that, going into the COVID lockdowns and coming out of the COVID lockdowns, the Fed has failed miserably. And I would say that to them, to their face, if they would have me, but of course they're not going to. And I don't think that they're capable of being embarrassed anyway. So I don't know that it would do any good other than that cathartic release of letting them know exactly what I think about them. But quite frankly, since March of 2022, or in the months leading up to March of 2022, they were completely asleep at the wheel. Oh, there's no inflation. There's no concern. It's going to be transitory. We need more inflation. You know, they said all of these things about where we were and frankly where they put us. Let's put the responsibility on the shoulders of the people that are driving the bus or driving the train. You can't blame the passengers because the bus driver took a wrong turn and you ended up in some neighborhood where you shouldn't be, and you're at risk now. That's not the passenger's fault. It's the driver's fault. And frankly, the Fed has been driving monetary policy. That's their job. That's their mission. And so starting in January of 2022, all these people were on record, including Janet Yellen, who is now the Secretary of the Treasury, was formerly a Federal Reserve chairperson, including Jay Powell, who is the current chairman of the Federal Reserve Board, and all of the governors and all of the other poobahs and presidents and whatnot. They were all singing from the same hymnal. We need more inflation. We're not worried about inflation. Inflation's going to come and go like the wind. It's going to be transitory, blah, 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 blah. And they were all wrong. I mean, not just wrong, but completely wrong, dead wrong. And so now we're sitting at at a rate of inflation year over year. So from last year, 2022, let's call it May, because these things are lagging. All these indicators lag by a month. But from May of 2022 to May of 2023, we have a rate of inflation at 4.7%, which is more than twice what the Federal Reserve Board has set as a target in their own metric. That's not me telling them what they need to do. That's not you telling them what they need to do. That is their own thing, saying, hey, we're going to keep inflation at 2% year over year. It's like you guys or me saying, you know what, from now on, I'm going to wake up at 5 a.m., army early. I'm going to go for a run. I'm going to do this. I'm going to do that. And then you blow it completely. You stuff your face with bonbons the night before. You sleep till 9 o'clock. You don't exercise. You're late for work. Who's to blame, right? You can't blame your neighbor for saying that you should do this. You're the one that said that you are going to do this and that you plan on doing this, and you dropped the ball completely. Well, that's what the Fed has done. They've dropped the ball completely. And now they're trying to play catch up and trying to salvage whatever reputation they think they have. Now, again, who really cares about the reputation of the Fed, right? Do you guys lose sleep at night wondering like, oh my gosh, what is the reputation of Jerome Powell? What will his legacy be? I think only Jerome Powell really cares about that. Maybe a few people who are very close to Jerome Powell. I'm sure he's got loved ones that care about his well-being, but the rest of us, right, we're too busy living our lives. That said, these folks are out there actively trying to salvage their reputation and trying to rewrite history, despite the fact that they so completely and miserably failed at their job that history should record them as villains in this process. And they are causing true damage and true pain. As I said previously in conversations, the way the Fed wants to solve the inflationary problem at this point and why they want to continue raising interest rates, the Fed interest rate, by the way, at 5%, let's say, let's take the low end of their range, the Fed interest rate that sits today at 5% is higher than the rate of inflation. Okay, so they are pushing with all of their might to try to get this inflationary pressure corrected. And they've got, I would imagine, very personal and very egocentric reasons for wanting to do that. I don't think it's because they really care about the economy that much. I mean, I'm sure they do, but I think, as I said, it's their reputation at stake. And right now they got a lot of egg on their face. And I think they want to erase that. And so that's why they're pushing so hard. But the end goal of getting to a 2% rate of inflation, in order to do that, they are causing or leading to cause or wanting to cause massive unemployment. That is part of the deal. And when I say massive, I don't have a number, but let me give you an idea of what the Fed themselves projected coming out of their meeting last week. They are expecting the rate of unemployment to be somewhere between 4.1 and 4.5% by the end of this year, calendar year 2023. So they're expecting, just for reference, right now, we're at 3.7% unemployment rate. We were earlier this year at 3.4% unemployment. So they want to see the rate of unemployment go up to, not see, but they're expecting as a result of their work and their efforts to control inflation, they're expecting unemployment to be somewhere between 4.1 and 4.5%. Those are real human beings, real people, our colleagues, our neighbors, people, in our community who are going to lose their jobs as a result of what the Fed is trying to do in order to correct their mistakes. That's real pain. Those are real human beings. And the Fed is saying that, in order to bring inflation under control, what they want to do is make unemployment higher. What does that mean? How does that work to control inflation? It's a very twisted sort of logic, but it works like this. If unemployment rate is high, meaning that lots of people are out of work, then the old saying goes, beggars can't be choosers. So if you need a job, because you're out of work, because you lost your job because of what the Fed's done, then when you finally get to an interview with some organization that is suitable for your skills, you're not going to hold out for more money, in theory, right? Because you need a job, you need a paycheck, you need to start today, not in 2 weeks, you need right away. And so people who need to get back to work and to start earning income, they're not going to hold out for higher salary. In theory, that's the Fed's thinking. they're also not going to expect a signing bonus. Or if you're still at your employer and you've been talking to other employers, you're not expecting to be able to get a stay-on bonus by, agreeing to stay at your current position, because the market is going to change. The employment market's going to change. And when it was at 3.4% unemployment, institutions and organizations, employers that needed people to work for them, were going to give higher salaries. We're going to give signing bonuses or some other incentives to try to attract talent, because, hey, we need somebody right now. When the unemployment rate hits 4.5% by the end of this year, which is what the Fed is projecting, people are going to be less likely to hold out for more income, for higher rate of pay, for signing bonuses, et cetera, because, hey, I need a job right now. I'm in dire straits. And so that sort of thing is what the Fed is trying to create and to accelerate, in order to make it so that people like you and me have less money in our pocket. When we have less money in our pocket, the psychology goes, we're going to be less inclined to spend it on things that we can push off to another time when we have more money in our pocket. So, for example, we will probably take fewer vacations. If we do take a vacation, we will probably do a car trip as opposed to an air trip, right? I don't know, it's hard to say. With gas prices where they are in Washington state right now, new record, we actually are the most expensive gas in the country now in Washington state. That's a really dubious distinction, and it's a jagged pill for me to swallow, coming from Texas, of course, where gas is, as plentiful as the iced tea, the sweetened iced tea that we would drink. But in any event, coming back to this, the Fed's goals with this employment and unemployment thing is simply this: when you have less money in your pocket, when you're earning less at your work, if you happen to have a job, then you're going to be more conservative in how you spend your pay. You're going to spend it on the necessities, not on the luxuries. And as people spend less money on all of these quote unquote luxuries, then the cost of these luxuries and these other goods are supposed to come down. And as the cost comes down, the rate of inflation tracked from last year at this time to this year at this time will come down as well. And voila, as the Fed would like to have you believe with their magic wand, inflation's cured. That's the theory. That's what they're doing, and they're doing it. I mean, look, they have said it, and they continue to say it. When Jerome Powell addresses members of Congress, members of the Senate, and they ask questions of him about their plan, that's actually part of the plan. Now, how much unemployment is enough? Hard to say. They're never going to say that. I don't know either. I don't know if 4.5% is going to do it, if 5% is going to do it. And look, once the genie's out of the bottle, it's hard to say when the genie stops doing whatever the genie is going to do, right? Once you put a bull in a china shop, so to speak, who's to say that the bull's only going to break this stuff over here and not smash that stuff over there? Who's to say what exactly the end result is going to be here? Because the Fed certainly does not know. In fact, one of the most diabolical and despicable things I heard Jerome Powell say recently, when I heard it, I wasn't there in the room with him. Okay, so give me a little bit of a break here. But he was quoted as saying this. I saw the video of him saying this. We're just now beginning to understand how little we understand about inflation. He literally said that 3 months ago. This is the person who is in charge of keeping inflation in check. This is the person who is in charge of maintaining monetary policy, which is how we pay for what our government, our federal government, spends through fiscal policy. And this guy, let me say it again, we're just now beginning to understand how little we understand about inflation. That to me is really not comforting. Imagine going to a doctor, like you've got real problems, God forbid, heart problems or something, serious in your health. And your doctor says to you, we're just now beginning to understand how little we understand about your diagnosis. Wow, that is really scary. And this guy is, that's the person in charge. So we've got a lot of work to do. And we've got a lot of problems to overcome here. Let me take a look at time. Cool. So we got a few more minutes here. Let me tell you the good news. There's always good news. And really news is how you make it. But the good news is that we're not alone in our fight against inflation here in the good old US of A. Other countries, globally speaking, are also really in trouble and really fighting for their economic livelihoods. This is a global problem. And I'm not suggesting that misery loves company. I know that that's an expression, and I intellectually, I understand it, but emotionally speaking, I don't think anyone's like, I wish other people, globally speaking, were as beat up as we are, because that'll make us better. It doesn't. Everything in our economy, globally speaking, is interconnected. So if other countries are experiencing real economic hardship, it's going to have an impact on our market. And we're seeing that in the markets today and yesterday, because the Bank of England, our friends, as we're coming up on the 4th of July. Yes, one of the best rituals of summer, blowing up fireworks and overeating and grilling and all the rest of that stuff. But the Bank of England, I got notes right over here. Check it out. So let me read this to you. They just hiked. The Bank of England is the equivalent of our Fed. They just raised their interest rates by 50 basis points, by 0.5%, which is higher than they were expected to. They were expected to raise only 25 basis points, or 0.25%. They raised twice as high, by 50 basis points. That is their 13th rate hike. That's the Bank of England. The Bank of Switzerland, they raised their interest rates by 25 basis points, 0.25%. Now, when I say the Bank of Switzerland or the Bank of England, again, I'm speaking about those central bankers, the counterpart of the Fed, just in a different country. Let's see here, more notes for you guys. Norway, their central bank raised their interest rates by 0.5%, which is more than was expected. That is the 11th time the Norwegian central bank has raised their interest rates. This one is a shocker. You guys are going to be frightened when I say this number out loud. The Central Bank of Turkey raised their interest rates by 6.5% in one session. So it went up to 15.5%. I'm sorry, 15% is where they are right now. So where they were a couple of days ago was 8.5%. And they just cranked that bad boy up to 15% in one session. They moved it that high because the rate of inflation in Turkey is 40% year over year. Think about that. That is roughly 10 times higher than where our rate of inflation is right now. That is an incredibly scary number to even consider. Some countries are even more bleak in their outlook. The Argentinians, as an example, and I'm really excited about Argentina from a personal perspective. I'm curious about Buenos Aires. I'm wanting to travel there because, as y'all know, I love beef, and Argentinian beef is probably some of the best beef on the planet. And where there's good beef, there's good dairy cattle, and dairy cattle make great cheese and great ice cream. And so what's not to love? The only thing I'd say is not to love is the Argentinian rate of inflation is above 100%, which is dreadful for people who earn money in the Argentinian currency of the Argentinian peso. If you're a tourist and you earn money overseas, you can live really good there or travel really good there as a result of that. But that does no good for the Argentinians. In any event, the rate of inflation globally is exploding because of the central bankers and the mistakes that they made. We look at our Fed as a main culprit because, number one, we're Americans, but more to the point, we have the largest economy globally speaking. And so everybody is curious and concerned about what our economy does. And when our economy sneezes, other economies catch a cold or catch pneumonia. It's just that big, what we are in this world. So we have some issues. We definitely have some issues. And I don't have a whole lot of positive things to say about the people, as I mentioned, that are driving this bus. They failed miserably. They are continuing to, I'm not sure exactly what the end game is here, but they are insisting that they're going to bring this down to 2% year over year inflation, which is a target number, by the way, that is pulled straight out of thin air. Straight out of thin air. The person who pulled that number out of thin air is a woman named Janet Yellen, who is our current Treasury chairperson. And she pulled that out of thin air. Now, Janet Yellen is not an uneducated person. She graduated from Yale. She has, I imagine, a PhD in economics. She has worked in government and policy most of her life, if not all of her life. She's currently the Treasury Secretary, but she also was chairperson of the Federal Reserve Board, and she's worked as a governor of the Fed. She's been around. Many years ago, there was some kind of conversation with Janet Yellen and a previous Fed chairperson, and I don't know, guys, so don't hold it too much against me if it was Alan Greenspan or somebody else. But basically at that time when they were talking about like, what is the right amount of inflation from one year to the next, Janet Yellen is the person who said 2%. I don't know where she pulled that number out of thin air or out of here or out of some other place. Y'all figure that out on your own. I have no idea where that came from, but it stuck. It kind of got out of the room. There was in a closed door meeting or conversation. It got leaked to the media, and before you know it, the way things happen in DC and in the policy centers of the world, that kind of became the number, the standard. And so, but you know, here's the thing. Once it's the standard, right? It's become kind of like the benchmark. And so for years and years and years, and Janet Yellen's not a spring chicken. She's been doing this for decades. So for as long as she's been around, that number has been kind of like the standard that the Fed has tried to maintain with regard to the rate of inflation. And now, here's the other silver lining, if you want to call it that. They've brought this bad boy down from 9% earlier this year. Think about that. Or last year, excuse me. I get jumbled up with my calendars. But last year at around this time, we were somewhere in the 9s on inflation. And so, yes, the Fed has done a great, I'm sorry, I'm being complimentary, but they've done a job to bring it down from 9 to at least 4.7, where we are currently sitting. Now, that is 150% higher than where they want it to be, but it's not, 400% higher, which is where we were at 9%. So yay, kudos, I'll give credit where credit is due, but the rest of this year, it's gonna be tough. And by the way, by the Fed's own estimation, they believe that the rate of inflation year over year by the end of 2023 is going to be somewhere between 3.6% on the low end and 3.9% on the high end, which again would be great if it started with a 3, considering that earlier last year, whenever it was, it started with a 9. That's great. But at 3.9%, you're still roughly 100% higher than your own stated target and your own stated goals. So a lot of work to do. And that's by the end of calendar year 2023. That's what the Fed is saying they expect. So we are in for a ride, guys. I'm an optimistic person. Summer's here, sun is shining. It's grilling time. It's going to be the 4th of July soon. I am optimistic that things always work out one way or the other. So I am absolutely thrilled that we are where we are right now. But as far as like giving credit to the Fed and giving them, that slap on the back and that attaboy, attagirl sort of thing, no, not at all. I think they failed miserably. I think they continue to fail miserably. I think that their expectations and their projections are pulled straight out of thin air. And I do not believe that they really care about the actual damage that they're going to do to people and households as they try to correct the mistakes that they made over the last 15 months and previously as we were coming out of COVID. I just simply, they are going to continue to be very comfortable. They're going to continue to go to their cocktail parties. They're going to continue living their lives. And while there might be a slight concern about the damage that they're causing, I think that those are crocodile tears at the end of the day. That's my 2 cents. I am what I am. But these are the people we're stuck with. And I can't change it, and neither can you. So we just have to deal with their shortcomings and make it work to the best of our ability. We've been through worse as a country. I don't know if you guys remember the late 1970s, early 1980s. We've been through worse. We'll get through this. I am a firm believer of that. So that said, go out, enjoy the summer, enjoy that beautiful sunshine, get your grill on, put something yummy on that hot fire, and enjoy time with your family, enjoy time with your friends. Summer, at least in Seattle, is we wait for it all year. We really do. And when it finally shows up, it's a celebration. So I'm going to wish you guys a wonderful weekend. I'm going to tell you that I'm not going to be here next week because I've got a friend who's getting married, and I'm excited to be celebrating that beautiful union. So I will see you in 2 weeks, which is actually right around the 4th of July. Yay, America. I love it. I hope you guys have a fantastic day, a wonderful weekend, wonderful couple of weeks. And if you need anything, you know where to find me, so don't be shy. Until then, stay safe, stay healthy, stay sane, and I will see you next time. Y'all take care. Bye-bye.